Something extraordinary just happened in the silver market, and I need you to hear me out for the next few minutes, because what I'm about to show you is the kind of thing most financial analysts aren't talking about yet, at least not publicly. The last affordable entry point for silver may have just closed. I want you to think about something for a second. When was the last time a single asset checked every single box at once? A structural supply crisis, explosive industrial demand that isn't going away, geopolitical forces actively pulling supply off global markets, central banks doing something they haven't done in decades, and a paper market that is cracking at the seams? Because that's exactly what's happening in silver right now. And the window that existed even a few months ago, that window where everyday Americans could still accumulate this metal at what will one day look like bargain prices, that window is closing today. Let me take you back to something that happened in the late 1970s, because history has a way of rhyming, and right now it's rhyming so loudly I can barely hear myself think. Two Texas oil billionaires, Nelson Bunker Hunt and William Herbert Hunt, watched inflation erode the purchasing power of their enormous family fortune. They looked around at a world being shaken by oil embargoes, political turmoil, and a Federal Reserve that had let inflation run completely off the rails, and they made a decision. They decided that silver was the only real money left. They started buying. Quietly at first, then aggressively, then obsessively. By the time anyone realized what was happening, the Hunt brothers, along with allies including Saudi royalty, had accumulated nearly 200 million ounces of silver. The price had gone from roughly $2 an ounce all the way to nearly $50 an ounce. People who had bought in early made life-changing money. People who waited and thought it was too late paid full price. What ended that run was a regulatory intervention. The exchanges literally changed the rules mid-game to stop the squeeze. They called it Silver Thursday, March 27th, 1980. The market crashed overnight. Now, here's what I need you to understand. What is happening today is fundamentally different from that, and in many ways, it's far more dangerous to sit on the sidelines. The Hunt brothers were two men trying to corner a market. What we have today is not two men. What we have today is a civilizational shift in how silver is consumed, combined with a supply system that was never built to keep up with it. Consider this. Solar panels require silver, not as a trace ingredient, as a core component of the photovoltaic cells that convert sunlight into electricity. And solar deployment has exploded. In just the last decade, the demand for silver from the solar industry alone has increased roughly 12 times over. 12 times. We're not talking about a trend that's maturing. We're talking about a trend that is still in its early stages, as developing nations electrify, as governments mandate green energy transitions, as utility-scale solar becomes the cheapest form of electricity generation on Earth. Every single solar panel that goes into the ground takes silver with it, and that silver doesn't come back. It's consumed, gone. That's before we talk about electric vehicles. Every electric vehicle on the road uses significantly more silver than a traditional combustion engine vehicle, roughly 2 to 3 times more. And EV adoption is accelerating, not slowing. The auto manufacturers have made their bets. The infrastructure is being built. The charging networks are expanding. Every car rolling off those assembly lines is pulling more silver out of circulation. Then there's the electronics sector. Every smartphone, every data center, every piece of military hardware, every advanced medical device. Silver is the most electrically conductive metal on Earth, and that property is irreplaceable. You can't substitute aluminum into a solar cell the way you might substitute it in an airplane fuselage. The laws of physics don't negotiate. So demand is not the question. Demand is rocketing upward on every front simultaneously: industrial, technological, monetary, and investment. The question is, where is the supply supposed to come from? And that is where this story gets deeply concerning. Here's a fact that almost nobody in mainstream financial media is discussing. Approximately 70% of all silver mined in the world is not mined because someone was looking for silver. It is mined as a byproduct of lead mining, zinc mining, copper mining, and gold mining. Silver comes out of the ground whether those miners want it or not, as a co-product of whatever primary metal they were actually trying to extract. This means that to get more silver, you generally have to get more of those other metals first. You can't simply build a new silver mine and turn on the tap. The economics don't work that way. The silver supply is, for all practical purposes, relatively fixed in the short to medium term. You cannot meaningfully increase it in response to a price spike. It takes years, sometimes a decade, from the time a new mine is discovered to the time it begins producing. The pipeline is empty. The Silver Institute tracks global supply and demand with extraordinary precision, and what their data reveals has been flashing red for years now. The silver market entered a structural supply deficit, meaning demand exceeds supply, years ago, and that deficit has now stretched to its sixth consecutive year. The cumulative amount of silver that has been drawn down from above ground stockpiles during this period is staggering. We're talking about hundreds of millions of ounces that were sitting in warehouses, in ETF vaults, in dealer inventories, and they are gone. Not recycled, not replaced. Gone into industrial applications that consumed them permanently. And if that story weren't alarming enough on its own, something else happened that changed the entire geopolitical architecture of the silver market. China, the world's largest industrial consumer of silver, reclassified silver as a strategic material. Think about what that means for a moment. When a government designates something as strategic, they are signaling that they view it as critical to national security and economic sovereignty. They are signaling that they will prioritize domestic stockpiling over export. China's move sent shockwaves through the silver trading community because China had been both a significant producer and exporter of silver for years. When that export pipeline narrowed, the pressure on Western markets, particularly the COMEX in New York and the London Bullion Market Association, became intense. Speaking of the COMEX, let me explain something about how silver is actually traded in the modern financial system, because understanding this is key to understanding why what's happening right now is so extraordinary. When most financial institutions buy silver, they aren't actually buying silver. They're buying paper contracts that represent silver. Futures contracts, forward contracts, certificates, ETFs backed by nothing but other paper promises. The entire derivatives market for silver is many, many times larger than the physical silver market. For decades, this worked fine because almost nobody actually asked for delivery. You'd buy a silver futures contract, watch the price, sell the contract for a profit, and walk away. The physical silver never moved because you never asked for it. But something shifted. Institutional investors, large funds, sovereign wealth instruments, the kind of players who move markets, began demanding physical delivery. Not paper, not promises, physical metal delivered to a vault, audited, verified. And when they started asking for the physical metal to back up all those paper contracts, they discovered something terrifying. The inventory wasn't there. COMEX registered silver inventories, the silver officially earmarked and eligible for delivery, plummeted. The Kobisi letter, one of the most closely followed institutional market intelligence services, flagged the dramatic decline. The ratio of paper silver contracts to physical silver available for delivery tightened to levels that market veterans hadn't seen in a very long time. This is what we call a physical squeeze. And it's not a theory, it's arithmetic. Now, before I go further, if you're someone who's been watching this space and wondering what to actually do about it, I want to mention something quickly. I put together a free guide that walks through the strategies thousands of American retirees are using right now to protect their hard-earned wealth from exactly this kind of monetary and market upheaval. It's in the description below. It covers practical steps, not just theory. Go check it out. I'll be here when you get back. So let's talk about what the institutions are actually doing, because this is the part of the story that gets almost no coverage. Central banks, the institutions that create money, that hold foreign reserves, that backstop entire national financial systems, have been accumulating precious metals at a pace not seen in modern history. Most of the attention has gone to gold, and rightfully so. But what fewer people are tracking is that the same forces driving central bank gold accumulation are now beginning to ripple into silver. Emerging market central banks that spent decades holding US dollars and treasury bonds as their primary reserve asset have watched the value of those reserves get eroded by inflation, geopolitical sanctions risk, and dollar weaponization. When the United States froze Russian sovereign assets, every central bank on Earth quietly began rethinking their exposure to dollar-denominated reserves. The question they all started asking was, what asset cannot be frozen, cannot be sanctioned, cannot be inflated away? The answer, as it has been throughout thousands of years of human civilization, was physical precious metals. And here is the critical piece of the puzzle that most amateur investors miss entirely. When institutional players, and now central banks, shift their allocation towards silver, the math becomes violent on the supply side. Silver is a tiny market compared to gold. Gold is a tiny market compared to bonds. Bonds are a tiny market compared to global derivatives. When even a fraction of the capital that flows through those larger markets decides to rotate into physical silver, it overwhelms available supply almost instantly. You cannot gradually accumulate silver the way you might gradually accumulate treasury bills. There isn't enough of it. When the buying accelerates, the price doesn't walk higher, it gaps. We saw a glimpse of this dynamic play out in the early months of this cycle, when silver ran to levels not seen since the Hunt brothers era, and then ran past them. Silver surpassed $100 an ounce for the first time in its history. Let me put that in context. That move represented a gain of over 290% year over year. Even after the pullback we've seen, as markets digest that explosive move, silver remains up nearly 90% on a year over year basis. Not 90 basis points, not 9%, 90%. And people are still asking if they missed it. Here's how I want you to think about this. Imagine you're standing in front of a dam. The dam has been holding back pressure for years, 6 consecutive years of structural deficits, cumulative drawdowns of hundreds of millions of ounces from above-ground stockpiles, growing industrial demand, geopolitical supply disruptions, institutional awakening to the paper versus physical discrepancy. The dam hasn't broken, but small cracks are appearing. The water is starting to find its way through. The question isn't whether the dam breaks. The pressure is too great for it not to. The question is whether you're positioned before it does, or whether you're watching the flood from higher ground, wondering why you didn't act. The gold to silver ratio is one of the most reliable long-term signals in the precious metals market. Historically, going back centuries, the ratio between gold prices and silver prices hovered around 15 to 1, because that's approximately the ratio at which these metals exist in the Earth's crust. In the modern era, with industrial demand reshaping the fundamentals, that historical ratio has shifted. But even against modern benchmarks, silver has been historically cheap relative to gold for most of the past decade. When the ratio is elevated, when it takes far more ounces of silver to buy 1 ounce of gold than historical averages would suggest, it has historically been a powerful buy signal for silver. The ratio began compressing rapidly as this cycle gained steam, falling to levels not seen in over a decade. That compression isn't random noise. It's a signal that the market is beginning to recognize what the fundamentals have been screaming for years. Silver is undervalued relative to gold, relative to inflation, and relative to the demand forces reshaping its consumption profile. Now, I want to talk to you directly for a moment, specifically if you're someone who has worked your entire life to build a retirement nest egg, and you're watching what's happening to the value of your savings in real time. The threats to wealth preservation aren't abstract anymore. Inflation doesn't ask for permission. Currency debasement doesn't send you a letter first. And a stock market that's trading at historically stretched valuations while corporate debt sits at record levels and geopolitical flashpoints multiply, from the Middle East to the South China Sea to Eastern Europe, that market doesn't care about your timeline to retirement. What we're living through right now is a convergence of risks that the mainstream financial planning industry was simply not built to address. Your advisor was trained in a world where the dollar was unquestioned, where bonds were safe, where diversifying between large cap stocks and small cap stocks counted as genuine risk management. That world is changing faster than the planning models can adapt. Physical precious metals, particularly silver, given where it sits in this cycle, represent one of the very few asset classes that benefits from the exact pressures that are threatening everything else. When inflation rises, precious metals tend to rise. When geopolitical uncertainty escalates, safe haven demand rises. When currency credibility is questioned, monetary metals rise. And when industrial demand for a metal explodes simultaneously, which is uniquely true for silver in this era of green energy and advanced electronics, you have a convergence of tailwinds that is genuinely rare. If you have retirement savings that you've worked decades to build, and you're not at least educated about what a precious metals IRA can do for you, I'd encourage you to take a hard look right now. A gold IRA, or in this case a silver IRA, allows you to hold physical precious metals inside a tax-advantaged retirement account. It's not a fringe concept. It's a recognized vehicle that tens of thousands of American retirees have used to diversify away from paper assets and into something with a 5,000-year track record of holding value. The process is more straightforward than most people assume. You don't have to liquidate your existing accounts or pay early withdrawal penalties. You simply roll over a portion of what you already have into a structure that holds real, physical metal. Given everything we've just discussed, the supply deficit, the institutional awakening, the geopolitical disruption, the paper versus physical tension building in the derivatives market, this is the moment that many financial historians will look back on as a turning point. The people who acted in this window, before the next leg of this move accelerated, will have positioned themselves well. The people who waited for more certainty, well, more certainty tends to come at much higher prices. Back to what I was saying about where we are in this cycle. One of the most telling developments has been the behavior of the Sprott Physical Silver Trust, one of the largest physically backed silver investment vehicles in the world. They doubled their capital specifically to acquire physical silver, not paper silver, not futures exposure. They went into the market and started taking delivery of physical metal at a scale that moved markets. When the largest players in the physical silver space are doing that, they're telling you something. They're not doing it because they think silver is overvalued. They're doing it because they've done the math on supply, on demand, on the deficit trajectory, on the COMEX inventory situation, and they've concluded that the physical metal sitting in vaults today will be dramatically more expensive to acquire in the not-so-distant future. The Sprott move also had a secondary effect. It made other institutional players nervous. When someone that large starts pulling physical silver off the market, the short sellers, the banks and funds that have been on the wrong side of this trade, start reassessing their exposure. Short sellers in a physical squeeze situation face a terrifying problem. They've sold silver they don't have, based on the assumption they can always find it when they need it. When the inventory dries up and the price accelerates, they have to buy to cover at whatever price the market demands. This is not speculation. This is basic mechanics. And it creates a feedback loop where buying pressure creates price pressure, creates more covering pressure, creates more price pressure, until something breaks or the squeeze exhausts itself. What makes this moment in silver's history categorically different from every previous squeeze, including the Hunt Brothers episode, is that the pressure is not coming from one corner of the market. It's not two billionaires trying to manipulate prices. It's the convergence of legitimate industrial demand that is structurally growing, a supply base that structurally cannot keep up, institutional investors who are belatedly discovering the paper versus physical discrepancy, central banks diversifying away from dollar-denominated assets, geopolitical powers reclassifying silver as strategic and limiting its export, and retail investors around the world who are simply reading the writing on the wall and deciding they'd rather own something real than something digital. Each one of those forces by itself might be manageable. All of them together, simultaneously, in a market this small, that is not manageable. That is a setup for a repricing of historic proportions. And it's already underway. We've already seen what the beginning of this move looks like. The question before you right now, today, before this video ends, is where you want to be positioned for the chapters that haven't been written yet. I've spent years watching markets and studying the patterns that precede the big moves, the ones that create genuine generational wealth for the people who saw them coming. And I can tell you that the setup in silver right now, the 6-year structural deficit, the industrial demand explosion, the institutional awakening, the geopolitical supply disruption, the COMEX inventory drain, the paper to physical tension, this is not noise. This is signal. This is the kind of convergence that happens maybe once every few decades, if you're lucky enough to recognize it when it's happening, rather than in the rearview mirror. The last time something this powerful was building in the silver market, the people who paid attention made their best financial decisions of their lives. The people who hesitated wondered for years what might have been. The sale, the quiet accumulation window where silver was still accessible at prices that today already look cheap and tomorrow will look even cheaper, may genuinely be over after today. Not because anything artificial is ending, because the natural forces of supply and demand have now fully awakened to an imbalance that has been building for half a decade. If you've made it to the end of this video, I want to give you something specific and actionable. That free guide I mentioned earlier, it's in the description. It covers the saving strategies that thousands of American retirees are using right now to protect their hard-earned wealth. But here's something extra for those of you who stayed with me to the end. If you're an American retiree with at least $100,000 in any retirement account, whether that's a 401k, an IRA, a pension, or any qualifying account, and you mention this video when you reach out, You'll get access to an exclusive, complimentary one on one educational web conference. No obligation, no pressure. Just a real conversation about what these markets mean for your retirement specifically and what options are available to you. This isn't for everyone. It's specifically for people who've built something worth protecting and are serious about understanding what comes next. Because the alarm has sounded, the signal is clear, and the last sale on silver may genuinely be over after today.